And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the second best day of the week for The Real Investment Show. Of course, it's Thursday, getting to wrap up this holiday shortened week. It's also the first day of June as we kind of get the month of May behind us. So there we go, get ready to wrap up the quarter. What does that mean? Well, it seems like we just finished earnings season. That's right, in a month we're gonna start earnings season all over again. So it's gonna come up on us very quick. Of course, as we get to the end of the quarter, this is also, we're now moving into a month where corporate share buybacks go into blackout period, which means companies can't buy their stock back prior to their earnings announcement. That's going to start to gain some traction here over the next couple of weeks. So that will remove one of the buyers from the markets. And yesterday the market did pull back here just a little bit. Not surprising. We've had a decent run here over the last couple of weeks. We were kind of pushing more than 2 standard deviations, really kind of above the market, particularly on the NASDAQ, not so much on the S&P, but yesterday, market gave up a little bit of that. It was a pretty quiet day, actually, a little bit of buying in the afternoon. But that was all kind of prior to the whole debt ceiling deal last night. The question was whether or not the House would actually pass it. Yesterday morning, we talked about how the bill had to pass the House Rules Committee. Once it did that, it would get to the House for a vote. Of course, the vote was last night. That passed with help of Democrats. Of course, there were about 35, or there actually roughly a little over 50 people had actually not voted for the debt ceiling, but there was enough Republicans and Democrats combined to get it passed. That now goes to the Senate. It is mostly assured, at least as far as we know, unless something dramatic happens, that it'll pass the Senate. So the debt ceiling will finally be behind us ahead of the deadline. Now, what does that mean, of course, is that now the Treasury will be able to issue debt. And the real kind of key to this whole debt ceiling bill is that now the government has unlimited spending until 2025. So there is no limit to how much debt that can be printed or published over the next 2.5 years until we get to the next debt ceiling debate, get past the next election. So it's now estimated that the debt will increase by about $4 trillion a year over the next couple of years as we have all these spending programs continue to kick into place. And again, nobody's now bridled by any stretch of the imagination to rein in any spending. And this is always the problem with these debt deals. They don't really curtail spending. Despite all of the maturation saying, oh, well, we're spending less money. Well, no, you're not really spending less money. All you did was claw back money you didn't use. So that's not really cutting spending. But now, again, there's really no debt limit here, so debt will continue to rise over the next couple of years. But initially what will happen, as soon as the debt ceiling bill is passed, the Treasury has to refund all of the accounts that it borrowed money from. And so the Treasury's been using emergency measures, and this is where they borrowed from federal pension funds and other pots of money in their Treasury general account, et cetera, to continue to pay the bills while this debt ceiling debate was going on. Well, now, and we'll talk about this more with Michael Leibowitz this morning, but now that has to be refunded. So immediately there is going to be a rash of debt issuance. Now, most of this will be short-term bills, and that will certainly probably send interest rates a little bit higher here over the next month or so as those bills get published and sold off into the marketplace. So again, we could see rates tick up here a little bit over the next couple of weeks, but it'll be over fairly quickly, and this debt will get bought and it will get put into the market. It's not going to be a collapse of the debt market or anything like that. It's just going to be a little bit of a wiggle in the market while these bills get issued and sold off into the market. The funds are raised and bills and the accounts are replenished. So we are going to see a contraction, though, in liquidity. We regularly produce this monetary liquidity index, which is basically the Federal Reserve balance sheet, the Treasury general account, and of course the reverse repo programs. That's actually been showing an increase in liquidity over the last month or so, which there's a decent correlation between that liquidity index and the S&P 500. So the fact the market's been rallying here, not surprising, given that kind of increase in liquidity in the markets. Well, that's going to reverse here on a short-term basis. So that may be a drag on stocks here temporarily. Again, markets had really kind of gotten ahead of themselves, particularly on the NASDAQ side. We saw this big chase into the whole AI, infrastructure deal. Semiconductors in particular, NVIDIA, AMD, et cetera, have had very, very, outsized moves. Very, very overbought. NVIDIA, for example, is 4 standard deviations above its 50-week moving average. So, I mean, it's extremely extended in a short-term move. So we're probably going to see a bit of a relaxation in some of those stocks here over the next month or so. Again, we're also moving into summer months. That tends to be weak. NASDAQ tends to have one of its weakest months of the year in the month of June. So if we're going to see a kind of a short-term correction, which would likely be a buying opportunity, it'll probably be in the month of June. So there's some things that are going on, of course, in the month of June that may contribute to a bit of a pullback here. Again, not a big correction, not anything outside of norm, but a bit of a relaxation in this rally wouldn't be surprising. And also, too, this is why we talked about yesterday, taking a little bit of profit here. So if you've got some of these stocks that have just really been on a tear lately, let's say that you own 2% of the position in your portfolio, or 3%, whatever it was. It's now 4%. Trim it back to whatever the original position size was. If it was 3 and it's now 4, trim it back to 3. It doesn't mean sell everything. When you say take profits, that doesn't mean sell everything. But, this is probably a decent opportunity to pare back on some of those positions a little bit, resize here a little bit, and then, when you get a pullback in the market, then you can buy, some shares back at a lower price and continue to own the position longer term. So just, kind of a way to think about your portfolio. Outside of that, really, again, there's lots of concern, and we're going to get into a couple of things this morning with Michael Liebowitz. There's certainly some things of concern here as we go forward over the next few months and get into the rest of summer. Typically tends to be a weaker time of the year. Manufacturing indexes continue to show signs of weakness. We saw the Chicago PMI yesterday. That's showing signs of weakness, which will feed into the manufacturing indexes. So we still have this concern over economic weakness, but it really hasn't manifested itself yet into things like job openings, which actually showed a kind of a decent surge in job openings yesterday. Quit rate continues to fall. That suggests that wages may stagnate here a little bit. But that's all kind of feeding this idea that the economy is slowing down here. But now on Friday, we have the employment number for May. So again, that's expected to come in right around 200,000 jobs. But ironically, over the last 13 months, the numbers actually beat those estimates every single month for 13 months. That is the largest number of beats in a row ever in history, and by a large margin. You don't normally have the analyst or the economist this wrong so many months in a row, expecting kind of weaker numbers, and yet that job number continues to come in exceedingly strong. So again, Friday's employment report expected right around to be around 200,000 jobs. But again, if we get another 300,000 job print on Friday, that's certainly going to weigh on the Federal Reserve and their outlook, because again, as we've talked about previously, and we're going to get into a bit this morning, more this morning with Mike, because the next Fed meeting is coming up. They're hiking rates to try to slow the economy and bring the unemployment rate up some to help slow down inflation and get the economy to cool down here a bit, and it hasn't been working. So the question is, on June the 14th, do they pause or do they hike? That's going to be the big question coming up, and we'll talk about that with Michael Liebowitz right after the break. Get by the website, realinvestmentadvice.com. Mike's latest article is out on the website about CBDCs. I've got some interesting articles coming out tomorrow, and of course this weekend's newsletter, all at the website, realinvestmentadvice.com. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Wow, Red, whatever are we gonna do over this hot, lazy summer?
Don't you worry, little darling. We gonna break our money malaise. Don't let the summer doldrums sap your money's worth. Register for our next Candid Coffee with Danny Ratcliffe and Richard Rosso with summertime tips for your idle cash. Saturday, June 3rd. It's our half-year financial checkup, breaking your money malaise this summer. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It is Thursday, of course. Get ready to wrap up this week. Of course, holiday shortened week, so it's been a quick one so far. And markets have been kind of holding in there. Yesterday, as I said, markets kind of pulled back here a little bit ahead of the whole debt ceiling debate. People just kind of unsure what was going to happen. But apparently enough backroom deals were cut that, we got the deal passed. And of course, the Democrats are going, look, it's so funny because this was their bill and we had to help them pass it. So, it's not a great look for House Majority Speaker Kevin McCarthy. So not really a great look for him. But anyway, that deal's done. As I said, it now goes to the Senate. It is fairly assured right now that it'll pass the Senate unless there's some surprise large number of holdouts in the Senate that nobody's really counting on. But right now, it seems fairly assured it'll pass. This will eliminate this whole overhang, and right, we can finally get rid of these ridiculous headlines about we're going to default on our debt and it's the end of the world as we know it. All these kind of all this hyperbole that's was put out there over the last several months. We said, hey, it's don't worry about that. That's the distraction at the moment, and now it's getting put away. So again, the next big step here, though, is of course the refunding of the Treasury account. So again, immediate questions are, and about this is, what does this mean for interest rates? What does this mean? This is surely going to, when they have to issue all this debt, this is going to crash the bond market, et cetera. So we're going to get into that this morning. We also want to talk about the Federal Reserve because right around the corner here, we've got the next meeting on June the 14th. And, will they hike or not? There's some, interesting problems that the Fed is facing at the moment in terms of much stronger economy than what they would like and a surging stock market. So a couple of things going on there as well. So all that we'll get into this morning. Mike, welcome to the show. So let's talk about interest rates and the bond market and this refunding of the general account. It's been interesting over the last couple of days as we were kind of approaching this vote on the debt ceiling bill. Bonds have actually been rallying fairly nicely.
Yeah. You know what? The Treasury is going to issue, they think, between 600, 800 billion of debt over the next few weeks. The large majority of it is going to be very short-term debt. 3-month bills, 6-month bills, 1-year bills, things like that. Mm-hmm. But what you have to know about the bond market, like the stock market and like other markets is it anticipates. It's not trading on what's happening today. It's trading on what they think will happen tomorrow. So, and we have enormous experience with this in the Treasury market because the Treasury is always auctioning off some kind of Treasury bill or note or bond. So what's going on today is not new. It's just the size. And typically, if the Treasury is coming with, let's just say, a 10-year auction, and the market thinks it's a little too much, the market will increase the yield in the days leading up to the auction. Because the way these auctions work is that Wall Street and the banks take down or end up owning a large majority of the auction, and then they redistribute it to their clients, to the quote unquote end user. So Wall Street doesn't want to buy something at a high price and sell it at a low price. So what they do is they back down the price, increase the yield going into the auction. That way they can try to buy it cheaper and then sell it back at the level it should be at. So with an auction, it's not that big a deal. It's a couple basis points over a couple days. You know, if it's a good auction, you get improvements. Sometimes the banks and dealers don't get the bonds they want, and they have to scramble to cover their shorts, and you can get a decent rally. Sometimes they, it can work both ways. But the bottom line is the market anticipates what's coming. The market has known this has been coming for months. It's been anticipating. We've seen yields trading higher, slightly higher, nothing like what we saw 6 months ago, but they have been grinding higher across the yield curve. And we've talked about the volatility in 1 month bills, but most of that was just around a potential delay of payments, related to the potential default. So I think, Lance, that the market has largely anticipated this. Now, we may see some sloppy auctions, Treasury bill auctions, which may affect the very short Treasury bills by a few basis points, and that effect may last for a few days. But I don't think there's going to be any meaningful effect on 5-year, 10-year, 20, 30-year paper, Treasury paper. Right. I think the market knows it's coming, knows what to expect, has already priced it in, and it will trade where it should trade. And that'll be, I think, much more based on economic data, where they think the Fed is going. We got another round of inflation data. We have employment on Friday. So all those data points, and the Fed meeting mid-month. So I think those are what's going to drive the bond market, and the auctions will have a very minimal effect, especially on the long end of the curve.
Well, and that's kind of the important point here, because, again, just, numerous headlines lately. It's like, oh my gosh, as soon as this debt ceiling's passed, interest rates are going to spike to the moon, and, just all these kind of, just this hyperbole that's, just across the, kind of across the financial media. And again, this goes to the same type of messaging we saw around the whole debt ceiling debate. It's like, well, if we don't pass it, we're going to default on our debt, and we've been through this. It's like, no, we're not. We've been through this, 78, 79 now times, other times, and this is the way it always works out. So again, it's just important to kind of keep things in perspective. It's so easy to kind of get wrapped up in the headlines, because you read this stuff, you go kind of in the media, you see it on the news. And most of it's nonsense, but it makes for great headlines, and it gets people to watch things. It gets people to, click to view articles, but it also gets people to make bad decisions within their portfolio because of emotional biases. And so again, we just, it's always important to kind of come back and focus, kind of on this. Just real quick, you brought up a couple of points. What, just kind of on average, what is the normal size of a bond auction normally when we do a bond auction?
They're all over the place, and it depends. The shorter term bills are much larger than the longer term bills, and I don't have the numbers. I mean, I don't follow the Treasury bill auctions. They're just not. They happen all the time. They're not big deals. The market absorbs them, and the other thing, Lance, is there's such great demand right now for money market funds, and guess what? That's what money market funds buy. That's what they own. Right. And when they're not buying it, Treasury, corporate treasurers are buying them, individuals are buying them. So that's another reason not to get overly concerned about the supply in the front end of the curve.
Yeah, and there's definitely a lot of money going into money market funds right now. So so that's providing a buyer for these short-term bills.
Yeah, it's actually, the timing is actually perfect for them. So they're gonna hit a market that wants that paper. And, you know, the other thing, Lance, is it's still a month, but we're going into quarter end.
Right.
So at quarter end, everyone tries to hold more cash. So, you know, that's kind of a liquidity issue to think about, too, as we kind of roll into these last 4 weeks, that the Treasury will probably increase their count at the Fed by 600 to 800 billion. The Fed will reduce their balance sheet by close to another 100 billion. And the reverse repo program, which the Fed runs, which is a liquidity tool, will probably suck out some more money, some more liquidity as well, because that tends to increase as you get closer to quarter end. So the three major components of what we call Fed liquidity are all going to take liquidity out of the markets.
Right.
It's all markets.
Right. And that brings up a really good point, too, because you mentioned this earlier, kind of just in passing. And I think it's important for people to understand how the Treasury bond market works. There's 20 primary dealers around the world, and those are your primary buyers at the Treasury auction. So when the Treasury says, and it's truly an auction, the Treasury says, hey, I'm going to issue $100 billion worth of T-bonds, then these 20 primary dealers, they basically bid on the bonds, and that's what sets the yield. To Mike's point, this is why the yield will move up or down, because it's what the Treasury, this Treasury auction is causing. And it's the buyers of these bonds from the Treasury, and that's setting the yield. And like Mike said, these 20 primary dealers in normal environments, right, going back to, forever, they would buy the bonds from the Treasury, and then they would sell it to their clients. So you would have an account at, JP Morgan or Bank of America, whatever, and they would buy the Treasury, and then they would sell you the Treasury bond. And the one difference that occurred during 2009, 10, 11, 12, 13, 14, 15 was when the Fed was doing quantitative easing, is that the primary dealers would buy the bonds from the Treasury and then 2 days later would sell it to the Federal Reserve. So the bond would just kind of make a loop and wouldn't actually get sold off to clientele. It would just get sold off to the Fed for quantitative easing. And that is a difference right now, Mike, is that the Fed isn't there as the stand-in buyer for these bonds.
Right. Now, there's another little wrinkle to the auctions, and they're called indirect bids. And anyone can bid the auction. You can go open an account at the Treasury Direct, and buy the auction. So, and what we've seen is that the amount of indirect bids has been large.
Mm-hmm.
So
that's right.
That may occur, and that may catch the dealers too short, where they have to come in after the auction and buy just to cover their shorts. So, it's been a really tricky environment for the dealers. And these large auctions are not going to be easy for them, trying to figure out where they can sell it at, where they need to buy it at, how much to short before the auction, et cetera.
Right. And it's going to be interesting, but I think that the key takeaway here is really twofold from Mike and I. Is one, don't panic over what's about to happen with the Treasury. We go through this every time we have a debt ceiling debate. In fact, you go back to 2011, which is the closest similarity what we just went through with this whole debacle issue. Yields actually fell after the debt ceiling was passed. So, that's the thing to kind of pay attention to here is, don't get wrapped up in the headlines. Pay attention to how these things actually operate. But even if there is an increase in yield, it'll be short-term in nature, and it won't be of magnitudes in proportion. It'll be a few, just a smidge, right? Just they'll tick up a little bit, but that'll be it. Ultimately, it's always about inflation and wages. We'll come back and talk about the Federal Reserve. Their next meeting coming up on the 14th of June. What are they going to do? That's coming up next.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Why, Red, whatever are we gonna do over this hot, lazy summer?
Don't you worry, little darling. We gonna break our money malaise. Don't let the summer doldrums sap your money's worth. Register for our next Candid Coffee with Danny Ratcliffe and Richard Rosso with summertime tips for your idle cash. Saturday, June 3rd. It's our half-year financial checkup, breaking your money malaise this summer. Register now at realinvestmentadvice.com. Candid Coffee with Ratcliffe and Rosso. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know inflation's bad when the headline this morning is "Don't Mess with My Wiener." The catalytic converter was stolen from the Oscar Mayer Wienermobile in Las Vegas.
Is nothing sacred?
Nothing is sacred.
The Real Investment Show podcast. Same show, your schedule.
It's happened, in our parking garage. In and out, you're off and running.
Gone in 30 seconds.
Yes.
At realinvestmentadvice.com.
To move with Nicolas Cage, gone in 60 seconds.
That was 60 seconds,
Yeah.
but he wasn't stealing catalytic converters. And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So coming up June the 14th is the next much anticipated Fed meeting. Will they, won't they? That's the big question, right? If you take a look at Fed Fund futures and kind of what it's predicting right now, that's actually been creeping up to about 5.35%, suggesting that the Fed's going to hike rates again. Now, the question is whether or not they hike at the next meeting or the meeting after, whatever. But it is suggesting right now that the Fed is going to have to hike rates some more. And even some recent kind of Fed speak has come out talking about the need to hike rates more. And again, as the employment and economic data continues to remain strong, that is certainly leading to this inflation remaining a lot more sticky than what the Fed would like. In fact, if you take a look at the core rate of inflation compared to what the Fed projections were in terms of where they thought inflation would be, inflation is currently tracking much higher than where the Fed's projection of their trend was supposed to be by this time. So again, they've hiked rates a lot. We've gone from 0 to 5% now on the Fed funds rate, and it's having a small bit of a minor effect on inflation, but prices are remaining a lot more sticky. So this is kind of a conundrum for the Fed. Friday is the next employment number. So we're going to see the May employment report. And that number, as I said at the opening, has been much stronger than analyst estimates over the last 13 months. In fact, that's the longest streak on record of outperforming the analyst. by a large margin. We've never seen such a streak before in history. And so it's kind of this anomaly of just how strong the job market has been over the last year or so as compared to what the Fed was wanting. So again, this is going to be a challenge for the Fed. Again, there's this whole, we've talked about, ad nauseum, this lag effect of rate hikes, and kind of keep waiting for the lag effect to show up, but it hasn't seemed to quite show up yet and where it matters, and that's where the employment is. So Mike, Fed coming up on June the 14th, will they, won't they? That's the next big question.
I don't know. I think the market's right. It's assigning about a 2/3 chance that they will. We still have the employment report, and I'm not sure exactly when CPI comes out, but either way, the Fed will have that number. But if I could go back to what you said, it's really fascinating if you think about what you just said. You said that the Fed didn't anticipate inflation would be this sticky, right? We also remember in late 2020, throughout 2021, high inflation was going to be transitory. It was going to spike and come right back down. It was going to last months, not years, right? The Fed has, and I saw this number once, and I think it's like 400 or 500 PhDs. Maybe it's 200.
Yeah, it's a lot.
PhDs, economists, right? These guys have gone through significant education, and my guess is most of them are at some of the best schools in the world, right? They can't predict this stuff, right? We can't predict this stuff. No one can predict this stuff. So I think it just should serve as a humbling moment for everyone and it's like the weather. We can't predict the weather. You can predict the weather for a day or so, but once you start going out a few days, the success of predicting the weather is poor. Right. So don't be so assured that we're going to have a hard landing, a soft landing, no landing. And just because the commentators on CNBC tell you we're going to have this or that, or the very wealthy private equity manager, or Jerome Powell, or a politician, or another Fed member, the key is we really have to think for ourselves. You have to follow certain key indicators that tend to lead, but understand what's going on. And I just think it's, the fact that the Fed is getting this inflation so wrong, they're getting employment wrong, they're getting economic growth wrong. So, will the market get it right? No, markets don't get it right either. They may get parts of it right, part of it wrong. But, Lance, we're going to go back to January 1st. We have to be prepared to audible. That means audible to the bullish side, audible to the bearish side, because we're in a very unique environment here. So as hard as it is predicting the economy, markets, inflation, you name it, it's even harder now because of everything that happened in 2020 and 2021 from the stimulus side, from our behavioral side. And this was global in nature, not just isolated to the United States or even just the G3 or G7.
Well, and again, this is the challenge the Fed faces is, we talk about this lag effect, right? And that, you've hiked all these rates and, you would have expected to see consumer spending slow down a lot more than it has, but retail sales were actually pretty decent last month. So again, we're not seeing this, this impact of these Fed rate hikes, and the Fed's got to be sitting there going, well, do we just kind of wait it out now and see? I mean, now one thing they did mention in the last meeting, and which is a true fact, is the bank lending standards have tightened dramatically, and that also acts as a rate hike on the economy because banks are lending out less credit. That means less access to credit, which means slower economic activity. So there is this other component that's also contributing to potentially slowing the economy, but even that has not seen a huge effect just yet. I mean, if you take a look, housing prices actually ticked up last month. So, it's, all the things you should be expecting to see, with interest rates at 5%, the highest they've been in, probably 30 years. On the Fed funds rate, we've seen the 10-year Treasury rise dramatically. Mortgage rates are back up to 6.5%, 7%. You would expect to kind of be seeing a really sharp slowdown, in the housing market. Housing stocks are near all-time highs, and it's just kind of baffling here what's been happening, inside the market, but how resilient the economy has been up to this point.
And I think this all goes back to what we've been talking about for God only knows how long, the lag effect. And it's hard to predict the lag effect in more normal environments. It's been much harder to understand the lag effect in this environment. So look, at the end of the day, interest rates are way too high for the baseline economic growth of this country, which is 1.5%, 2%. Interest rates are for treasuries 4%, for mortgages near 7%. Credit card loans are God only knows what they are now. Car loans, corporate loans. But it's just taking a while for those to hit. But we have seen it in some of the corporate earnings statements. Their interest expenses are starting to rise. They're going up at decent clips. Now, the reason that they're not just shooting higher is because they only have so much debt maturing at any one time. So as old debt matures, they tend to reissue it at current rates. And that's when they get hit by the rate effect, by the higher interest expense. Same thing is going on with the U.S. Treasury. And, the mortgage market, it seems healthy, and the new housing market certainly seems healthy, but there's just not much trading. People that are selling don't really have options on where to move to because they don't want to trade in their 3% mortgage for a 7% mortgage.
Right.
And the lower side of the housing market, you can't attract. It's really hard to attract new buyers because the mortgage rate is so high.
Right.
So, I just wonder if statistical measures of the housing market are just so off from what we're used to, just because there's just not much inventory, not much demand. So when there is a sale, which are fairly uncommon, in the grand scheme of things, it just skews the data, and It's not really representative of a good, healthy market.
Right. Well, and that's it's when you talk about the housing market in particular, a big number of the sales that have been occurring on the higher end have been all cash deals.
Right.
So, the people that have money, they're selling their house going, well, I'll just pay cash for, the next house. They're probably downsizing, whatever it is. So that's kind of been one of the anomalies. But yeah, to your point though, it's interesting, and we go back to the fact that there's still a tremendous amount of liquidity in the market, and that's one thing that's really been, potentially, delaying the onset of the recession, because, if you go through, back to, we sent checks to households, but we also increased a lot of benefits, child care benefits and unemployment benefits, et cetera. And some of those didn't run out till December of last year. So it's really just takes time. There's so much money still floating around the system that it just takes time for that money to leave and get extracted, and people have to turn to debt. And again, people have paid off credit card debt during the pandemic when they got all this free money, so they've got room to run these things back up. That's just going to delay that lag effect, of the next recession, a lot longer than people expect.
Right. Student loan payments were suspended until I think they have to restart in July.
Right. We talked about this yesterday. The moratorium will end in this month, and then the payments will start up in September the 1st.
September.
But that's still,
right.
That's about $38 billion a year in money that will leave the system to go pay student loan payments. So
right.
that's not a small thing.
Right. So these are all parts of the lag effect.
Yeah.
And kind of going back to the debt cap, there's still fierce competition, political divergence in the House and Senate. So passing major spending bills still isn't going to happen, even though the amount of spending will still be high.
Exactly. All right, quick break. We'll come back. Touch on a couple of things with the markets this morning. Futures pointing a little bit higher. S&P's up about 7, NASDAQ up about 30 right now. Kind of a little bit of relief. The debt ceiling's passed, at least in the House. Again, it's got to go to the Senate. Everybody's pretty confident it's going to pass there. Of course, the question is now what happens next? Markets ran right up into this. There was no real concern about this from the markets. So is it kind of a buy the rumor, sell the news? We'll talk about that. We'll come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Wow, Red! Whatever are we gonna do over this hot, lazy summer?
Don't you worry, little darling. We gonna break our money malaise. Don't let the summer doldrums sap your money's worth. Register for our next Candid Coffee with Danny Ratcliffe and Richard Rosso with summertime tips for your idle cash. Saturday, June 3rd. It's our half-year financial checkup, breaking your money malaise this summer. Register now at realinvestmentadvice.com. Candid Coffee with Ratcliffe and Rosso. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show today. You know, my wife's into, she loves all these podcasts and shows on whodunit, right? Those 48 hours, and she loves those podcasts on murder, unsolved murders, etc.
Crime.
She loves that stuff. Just so I'm reading this article right now because Tim Blefnick, forgive me if I'm pronouncing it wrong. He was the Family Feud contestant that he was on Family Feud in 2020, and he was asked what his biggest mistake was. He says, my biggest mistake was saying I do, which wasn't a good thing to say in television. Anyway, so his wife's murdered. They find the body, shot 14 times. And, they find, the most damning evidence. Let me just read this to you because it's too good to pass up this morning. The greatest evidence originated from Tim Blefnick's laptop, which included Google searches and website visits for instructions on how to pick locks, open windows from the outside, clean gunshot residue from a smoking gun, open doors with a crowbar, and trace shotgun rounds fired from a specific gun. So this is what he was searching. So I'm telling you all this now. So if I turn up missing, who done it?
Yeah.
Who done it? 48 hours. That's all the time you have to find the perpetrator. I'm just wondering.
Google search.
The Lance Roberts mystery.
It'll be on 40 hours. Cold case. Anyway, just let you know. Just putting it out there. Anyway, they apparently they have found him guilty of the murder now.
Oh yeah.
So
yeah, you think?
yeah. So anyway, and I never really understood that, right? Just get divorced and move on. Yeah. Now you're gonna spend the rest of your life in prison. I don't know. I don't get it. Anyway.
And she was a lovely looking woman too.
There's an old saying
I
about
know.
that.
I know. Just saying.
Just saying. Anyway, all right. So, big question now is, of course, as we kind of left off in the last segment, Fed, of course, going to hike rates. Will they, won't they, whatever, coming up on June the 14th. That's going to be the next worry for the markets right now. But so far, it really hasn't phased the market much. Since October, the markets have been in a very nice bullish trend here, doing exactly what you would expect, establishing higher highs, higher lows. It's just been a very nice trending process. Lots of negativity, right? Bullish sentiment is very low on the markets across both retail and professional investors. Nobody's really buying the rally at this point. And again, every time we rally, article after article after article, it's a bear trap and it's a bull trap, whatever it is. So there's just, everybody's very negative about the markets, but yet the market keeps climbing this wall of worry so far. And interestingly enough, if we go back to 2011, when we were dealing with the debt ceiling debate, and then of course, back then S&P actually downgraded the U.S. Treasury from AAA to AA. This time around, Fitch came out and said, "Oh, we're thinking about downgrading the debt because of the whole potential for default. We're going to downgrade the debt." Well, you should downgrade the debt anyway. We've got 31 trillion of it. We're 120% of GDP. Probably should downgrade the debt, but that's a different story. Right. But yet, in 2011, the market declined 20% heading into the debt ceiling deal because they were worried about the default. This time around, the market rallied right into the debt ceiling. So there's, the market has not been worried about this debt ceiling issue up to this point. The problem now, though, is the question is it now kind of a buy the rumor, sell the news thing? Because if you take a look at the NASDAQ, it's trading well into 3 standard deviations above its moving average. And that's some technical mumbo jumbo. It just means it's really stretched here. And that's been because of this whole AI chase, right? Apple, Microsoft, Google, Tesla, et cetera. Quick little fun fact this morning. Elon Musk bought Twitter for $44 billion. His net worth has now increased this year from January to the end of May by $55 billion because of Tesla. So he's basically bought Twitter for free at this point. But anyway, these stocks have been, driving up the market. We've talked about the passive indexing effect. And yet, really, there's been no concern. So the issue now becomes, kind of what happens next for the markets. And as Mike said, earlier, the best answer we have is we have no idea what'll happen next. It's just that's why we remain kind of audible. But the markets are getting overbought here short term. So again, if you take a look at the relative strength index on the NASDAQ is a good example. That's at very high levels. The S&P is creeping up there a bit. But here's the conundrum, right? If you take a look at the equal weighted indexes, they are not overbought. And so as we've discussed, there's been this big divergence in the market. There's basically been 3 sectors that are rallying and the other 7 aren't. So do we get a correction in the markets or just a big rotation? This is going to be the next challenge, Mike. What do you think?
Yeah. I mean, the market is in dire need of a rotation. And by that, we mean that tech and communications, discretionary, underperform and all the other sectors or most of the other sectors outperform. But, we can go through periods where just a few, like last year, energy and to a much lesser degree, value type stocks did really well. Everything else underperformed. And that kind of condition can persist for a while. Ultimately, yes, the market will rotate. But it's not as easy as saying it's extended, it's going to rotate immediately.
Right.
It can, we may go into a period now for 3 or 4 weeks where tech just is kind of flat, maybe goes down a little bit, where the other sectors go up a little bit. And essentially all those indicators of overbought, oversold get back to neutral. It's just time. Time can also relieve any overboughtness, oversoldness, or stress in the markets. So it's not clear cut that we're going straight back to the high dividend value energy sectors, and it's not clear cut that there's much gas left in the engine for these 5, give or take 5 stocks to keep dragging the market ahead. So June may just be one of those blah months where it just goes nowhere. But, the issue, the tougher thing to think about is that with those largest market cap stocks outperforming, they are worth, their contribution to the S&P is more now than it was a month or 2 or 3 months ago. So what they do has a much bigger say on what the market does. So we could have a market where, let's just say, the Apple, the Microsofts, and NVIDIAs drop 5%, and the other sectors are up 5%. a lot of you would say, well, the market will be flat, maybe up a little bit. The market will probably be down a few percent in that circumstance. So, what's been really important to do is look beyond the surface, look beyond what the indexes are doing and understanding what's going on beneath it. And I think in an up market and a down market, that will hold true. How healthy is the market? Is every stock kind of following the same path, or is it just a few? So if we start going down, also take a look. Is it just 3 stocks dragging the whole market down, or is it a large majority of stocks? And those heat maps are going to prove very important. They have been important for the last couple of months, and I think they're going to be something that we continue to look at daily to truly understand what the market's doing, because those indexes, the change in the daily changes in the index, aren't telling us much.
Right, and look, that's going to be the big frustration for investors, come the end of this year. We saw, and again, you bring up a good point, because we saw this last year. Energy was, up 40% last year. The rest of the market was down 20%. And almost like a light switch, it just changed. And, everybody hated FANG stocks in October of last year. Now they can't get enough of them, and they hate energy. So, it's the exact opposite this year. And again, these rotations occur like this, but they've been very dramatic over the last couple of years. And that's much more dramatic than normal. But again, to your point, I think this is, it's going to prove frustrating, because if you don't own a portfolio of just 7 stocks, 8 stocks, 9 stocks, you're underperforming the market right now. There's just, that's, or unless you just own the S&P, then you're just performing with the market. But anything you own outside of that, if you own emerging markets or, value stocks or whatever, you're underperforming, because this is a very narrow rally. I'm doing some work right now for our report next week. And, one of the arguments is like, well, if you take a look at the advanced decline line, this market breadth is actually, very strong here. And that's a very healthy market. And that's not really the case, because all market breadth tells you is the number of stocks that went up versus the number of stocks that went down. And so a stock may go up today, but be down tomorrow, and then up the next day and be going nowhere. But because of its daily price changes back and forth, which we're seeing a lot of that, it makes the advanced decline line look stronger than it really is. If you take a look at the index of the number of stocks that have a positive return for the year versus negative, that breadth really isn't there. And if you take a look at stocks that have been outperforming the index this year, it's a very small number. So, it's, and this is going to be the challenge for investors is, you're going to have a lot of investors that at the end of the year, they're like, well, I underperformed the index last year, so I got to do this and make some decision around whatever it is. But that's going to really be a faulty decision process because of this very narrow breadth in the market that's occurring.
Right, and we may get a reprieve for a few weeks. We do get some sort of rotation, and then we go right back to where we are for another 2 months of the same kind of activity. Yeah, exactly. In our commentary today, that will be going out momentarily, there is a graph showing the percentage of stocks that are over a certain key moving average. I think it's the 50-day, but I could be wrong. And it's very low compared to where we typically are when the market is running up like this.
Absolutely.
So again, another sign that most stocks are going nowhere.
Exactly. All right, Mike, thanks so much for today. And of course, we'll be back tomorrow. Danny Ratliff, Richard Rosso in the morning, of course, for Financial Fitness Friday. Make sure you're subscribed to the website for our weekly newsletter. That'll be out on Saturday, talking a little bit about the artificial intelligence revolution that's in the newsletter this weekend. And of course, also, I will have a blog post out tomorrow as well. But send us your questions, comments, emails, whatever we do to help you. Happy to do it. realinvestmentadvice.com. Have a great day.